You open up your bank account and quietly wonder where all of your money went. Everyone around you seems to be doing just fine, and you can't figure out why. You've heard about the stock market before, but honestly, the whole thing sounds like gibberish. Tickers, indexes, bull runs, it all blurs into noise that makes you want to quit. But here's the thing, that feeling of confusion is exactly where we need to start. My name is Ryan, and I spend way too much time thinking about personal finance. If you're someone who feels completely lost every time investing comes up, I see you. Make sure to hit the subscribe button and give this video a thumbs up too. Now, most people think the stock market is just gambling with a fancier dress code. And honestly, given how Wall Street gets portrayed, that reaction makes a lot of sense. But that belief is actually one of the most expensive misconceptions you could ever hold. Here's what most people don't realize. The stock market has quietly made ordinary people wealthy. Not hedge fund managers, just patient, ordinary people who started investing early and stayed consistent. And the wild part, most of them never once picked a single individual stock themselves. So what exactly is the stock market, and why does it move so unpredictably sometimes? Think of it like a giant auction where people buy and sell pieces of companies. Every share you buy is a tiny slice of ownership in that actual business, literally. When the company grows and earns more money, your little slice grows in value too. That's the basic idea. But of course, the reality is far more complicated than that. And that complexity is actually what keeps most beginners stuck on the outside looking in. Look, nobody taught us this stuff in school, and that gap has cost people enormously. A recent Gallup survey found that fewer than 60% of Americans own any stocks. That means roughly 40% of people are completely missing out on this wealth-building machine. And the number one reason they stay out? Fear. Pure, unexamined, completely unnecessary financial fear. Now you might be thinking, okay, Ryan, but the stock market crashes. I've literally seen it destroy people's hard-earned savings. Why would I ever invest? That's fair. Crashes are real and they genuinely do hurt. But there is one critical thing most people miss when they look at market history. The market has crashed dozens of times over the past century, and every single time, without exception, it has fully recovered and reached new highs. Think about this for a second. If you had invested just $1,000 in an S&P 500 index fund back in the year 2000, you would have lived through two devastating crashes, the dot-com bust and the 2008 financial crisis, and your account would have dropped dramatically both times. But if you had just held on and never sold a single share, that original $1,000 would be worth over $5,000 today. You would have grown your money 5 times over through 2 catastrophic crashes, simply by staying invested and refusing to panic, pull out, or sell. This is where it gets really interesting, because the biggest enemy in investing is not the market itself. It's your own emotional reaction to it. Studies from behavioral finance researchers consistently show that the average investor earns significantly less than the market itself does because of one single repeated mistake. That mistake is selling when the market drops and buying back in after it has already recovered, basically doing the exact opposite of what works. According to research from Dalbar, the average equity investor has historically underperformed the S&P 500 index by nearly 4 to 5 percentage points per year. Let that sink in. 4 to 5% less every single year, not because the market failed them, but purely because of emotional, panic-driven decision-making. Over a 30-year career of saving and investing, that gap can translate into hundreds of thousands of dollars in lost, unrealized wealth for everyday people. So before we go deeper into how the market actually works, we need to talk about the thing nobody ever addresses in beginner investing content. The thing I'm talking about is your relationship with uncertainty. Most people hate it. They want guarantees, and the market doesn't give you any guarantees. And here's the uncomfortable truth. No investment ever does. Not real estate, not bonds, not savings accounts, nothing. 0 guarantees exist in any financial vehicle. The real difference is that over long time horizons, the stock market has historically offered the highest consistent returns of any widely accessible investment option. The S&P 500, which tracks America's 500 largest companies, has averaged roughly 10% annual returns over the past 100 years of recorded market history. 10% a year. Let me put that number in context with a real dollar example so you can feel what this means for your future. Invest $300 a month from age 25, earn 10% annually, and by age 65, you will have over $1 million saved. $300 a month is just $10 a day, less than most people spend on coffee, subscriptions, or random impulse buys every week. What makes this truly powerful is not the $300. It is compound interest silently doing the work behind the scenes every single day. Compound interest means your returns earn their own returns. Your money makes money, and then that new money goes out and makes even more money. Albert Einstein reportedly called compound interest the eighth wonder of the world. Whether he truly said it or not, that concept is genuinely quite extraordinary. Compound interest rewards those who start early. The earlier you begin, the less money you actually need to invest to reach the exact same goal. I need to show you these exact numbers because seeing them for the first time is often what finally pushes people to actually start investing. The person who starts at 25 and invests for just 10 years will end up wealthier than someone investing for 30 years starting at 35. That sounds impossible, but the math actually backs it up completely, and it all comes down to exactly how early compounding starts working for you. The earlier investor gave compound interest more time, and that extra decade of growth created a gap that no amount of late contributions can overcome. This is not a motivational speech trick. This is simply pure mathematics, and it does not care about your age, income, or your excuses whatsoever. So now that we've established why the stock market matters and why time is your single greatest asset, let's talk about how it actually works. When a company wants to raise money for growth, it can sell small pieces of itself to the public in a process called an IPO. IPO stands for Initial Public Offering, and it is the very moment a private company opens itself up to everyday investors like you and me. Once those shares are listed on the market, their price moves up and down based entirely on one simple and powerful force: supply and demand. When more buyers exist than sellers, the price rises. When sellers outnumber buyers, the price falls. That is the entire pricing mechanism of the market. Now, what drives more people to want to buy a stock? Usually it is earnings growth, positive news, or confidence in the company's future direction. And what drives people to sell? Fear, bad earnings reports, economic uncertainty, or simply the human desire to lock in gains before something bad happens. Notice something? Both buying and selling decisions are driven by emotion just as much as they are driven by actual hard financial data and numbers. This is why understanding your own psychology is simply not optional. It is the most important skill any new investor can possibly develop over time. Let's talk about what you should actually invest in, because this is where most beginners either freeze up or make their very first costly mistake. A lot of people think they need to find the next Amazon or Apple, that one magical stock that will instantly make them wealthy overnight. That mindset is one of the most dangerous ways a beginner can approach the market, and it causes an enormous amount of unnecessary financial loss. Research from S&P consistently shows that over any given 15-year period, roughly 90% of actively managed funds fail to beat a simple index fund. Let me say that again. Even the professional Wall Street fund managers with entire research teams cannot consistently beat a boring index fund over time. So what is an index fund? It is essentially a basket that holds a little bit of every major company in one single investment product. When you buy one share of an S&P 500 index fund, you instantly own a tiny piece of all 500 of America's largest companies simultaneously. Buying into an index fund means you instantly own a small piece of Apple, Microsoft, Amazon, Google, and hundreds of other companies all at once. This one fact, that ordinary investors can access a diversified portfolio of the world's best companies with almost zero effort, is genuinely life-changing financial information. Here's the thing. This is not a complex strategy reserved for wealthy people. This is literally the approach Warren Buffett recommends for regular, everyday investors. Buffett has publicly stated multiple times that when he eventually passes, he wants his wife's inheritance invested in a simple, low-cost S&P 500 index fund. If that strategy is good enough for the world's greatest investor, it is absolutely good enough for you as a beginner entering the market today. You might be thinking, okay, Ryan, but how do I actually buy an index fund? And what platform should I even use to get started? Today, there are apps and brokerage platforms that allow anyone to open a free investment account and start buying index funds in under 10 minutes. Platforms like Fidelity, Vanguard, Schwab, or even a simple app like Robinhood have made investing far more accessible than it has ever been in history. There are zero commissions on most trades today, and you can actually start investing with as little as $1 through fractional share options. Old barriers keeping regular people out of the market are gone, yet millions of people still have not taken their very first investment step forward. Why? Because of one deeply rooted psychological barrier that no amount of accessible technology or zero-fee platforms can simply remove from a person's own mind. That barrier is the fear of losing money, not the logical risk of it, but the deep emotional dread of watching your hard-earned savings disappear. That fear is understandable, but staying out of the market has a very real cost that most people never stop to honestly consider or calculate. The cost of not investing is called opportunity cost, and it grows larger silently with every passing month you choose to stay on the sidelines. Every year you delay investing is a year of compound growth that is permanently gone, and those early years are the most valuable of all. There is a concept called dollar cost averaging that removes the pressure of trying to time the market perfectly, and it changes everything for new investors. Dollar cost averaging means investing a fixed amount at regular intervals, weekly, monthly, regardless of whether the market is up, down, or moving sideways that week. This strategy removes the burden of predicting the perfect moment to invest, which even the best professional investors in the world consistently fail to do. Let me give you a simple, concrete action plan right now, because at this point, information without action is just well-intentioned and very expensive entertainment. Step 1. Open a brokerage account today. Not tomorrow. Not after you do more research. Today, pick one of the reputable platforms I mentioned earlier. Step 2. Pick a monthly amount you can commit to without stress. Even $50 a month is a real, meaningful, and powerful starting place. Step 3. Automate the investment to happen automatically on the same date every month without requiring any decision, effort, or willpower from you at all. Automation is arguably the single greatest behavioral hack in personal finance. Once investing is automatic, your own emotions can no longer sabotage your financial future. The market will absolutely drop again at some point, but with automated contributions, you will buy more shares cheaply and benefit greatly once it recovers. When the market drops and you keep investing, you are buying great companies on sale, a scenario that long-term investors genuinely welcome rather than fear. That reframe from market crashes being terrifying to being opportunities is what separates people who actually build wealth from people who never quite get there. The stock market is a wealth engine that consistently rewards patience, consistency, and time. And those three things are entirely within your power to give. You do not need a finance degree or a large income. You just need to start, stay consistent, and trust the long-term investing process completely. The people quietly building wealth today are not smarter than you. They simply started. They chose not to wait for a certainty that never arrives. This is your moment. Open the account, start small, and stay consistent. Your future self will thank you far more than you can currently imagine.